Hello fellow traders, and welcome to our new trading format for this trading newsletter. Greg Capper just discussed above the screenshot of the market internals as well as the broader markets with a neutral to slightly bullish bias. As we love trading options, we can come up with many compelling patterns regardless of a compelling bullish or bearish position in the market. We have today one new wealth building option trade for you and one new income generating play. The first one, as you see on the chart here, is a weekly chart of GPRO. The stock got slammed from its post-IPO high of over $65 and cratered to around $8 at the beginning of the year and has been consolidating ever since. Last week, it is finally showing signs of life with the increased volume and breaking out over the prior highs on the weekly chart. This is now in an uptrend on the weekly chart. Even though the monthly chart is not shown, it is oversold and also stabilizing with a lot of room to move to the upside. We are thus going to recommend a bull put spread on GPRO. We're going to, because we believe it's more of a longer term bottom and there's many different types of bullish option trades a trader could deploy, we are going to recommend as a favorable reward to risk trade selling a November bull put spread. Now for the beginners, a quick refresher is we are going to sell an out of the money put, and we are selecting the $14 strike. So what that obligates the put seller to do is buy GPRO, the underlying, on or before November expiration at the $14 a share. It is currently trading, as you see, $17.15 is where it closed last Friday. So that is over 18% away from the current price. And in exchange for that, we are getting 80 cents a share for assuming that obligation to buy GPRO at $14. Now we are going to not sell those puts naked, but we are going to sell the bull put spread. So that involves buying a further out of the money put as downside protection and to lower our margin requirement. We're recommend buying the November $10 put. So we're going to sell the November $14 put. We're going to buy the November $10 put for a net credit of 76 cents a share. For simplicity, we're just going to show you the math from this point forward on a 10 lot. So since one option contract represents 100 shares, a 10 lot represents 1,000 shares. Therefore, by selling a 10 lot of this bull put spread, you will take in $760 immediately into your account. The maximum gain, as it is for any option seller, is the premium received, $760 in this case. The margin on a spread is just the difference in the strike prices, which is $4 in this case, $4,000 on the 10 lot. So 760 premium that we took in divided by the 4,000 margin gives us an astonishing 19% return on investment in just 53 days, assuming you put on this trade Monday and held it until expiration, provided it closes above the higher strike price of $14 a share. That $760 is 100% profit that ends up in your pocket. We are recommending a wide protective stop loss, just under $12.50. This stock, all it needs to do is continue sideways, can pull back no greater than 18% or move higher. All three scenarios, the bull put spread seller keeps the full premium. Now we also have discussed in the letters, you can see some other candidates like we'll do every time both on wealth building trades and watch candidates on income producing trades. We are categorizing, as you saw above in our description of the new format, the income building trades as shorter term. They can either be a directional trade, but primarily because we prefer selling options, not buying options, and that is because we win over 90% of the trades by being an option seller. Then you will notice that we are going to have a bias on selling options. You see here now the weekly chart of TAP, Molson Brewery Company. That tail you see in July was real. It whipped down there to $90 and quickly snapped back to make that a huge shakeout bar. It has been consolidating for a number of weeks and also broke out this month, making new highs in this bullish consolidation uptrend. I am now going to show you this quote screen for the various puts on TAP that expire this coming Friday. And as you will see, this is what's setting up this extraordinary put selling candidate for us. I have been monitoring this trade because we actually recommended selling some further out of the money October puts a few weeks ago. So I'm still in that trade, but I noticed when I was monitoring my trade that these puts at the $90 strike level that you're looking at, again, they expire this coming Friday. I would like to direct your attention to, let's start with the $100 puts here. They're bid at $1.40, offered at $2.05. Traditionally, we would not be recommending this trade as an income candidate because of the illiquidity. We prefer trading very liquid stocks because then it's easier to get in, it's easier to get out without slippage and having to pay a huge spread. This is bid at $1.40, and as the strike price goes down, which means it gets further away out of the money, it is natural that the quotes should proportionally get lower. So this dropped from $1.40, $1.25, $1.10, so on and so forth. And then I noticed the $90 puts, which are the furthest out of the money for this week's expiration, had this extremely rare high price bid of $1.05. Now let's review what selling that put means again. If we sell these $90 puts, that is giving somebody else the right, but not the obligation, to require us, the put seller, to purchase TAP for $90 a share on or before this Friday's expiration date. Now bear in mind, with TAP closing at $106 or so, this is 15% away from its closing stock price on Friday. So the stock could fall a whopping $16, and we still get to collect that put premium by selling the $90 puts. So that is exactly the trade that we are recommending as our short-term income option trade for the week. We are recommending selling 10 of these weekly $90 puts at $1.05 a share, which will bring in $1,050 to your account. That is pure profit, provided the stock trades, or closes rather, above $90 by this Friday. If for some unknown crazy reason it gaps down or goes violently against us, we will take assignment at the $90 strike price, and then we will manage it with further option trades around it. But taking in that $1.05 a share gives us a cost basis, if it's assigned, of $88.95. The rate of return, if this put that we're going to sell expires worthless this Friday, is a staggering 6.5% in 5 trading days. I will let you mathematicians do your own math if you wanted to see what that is annualized, but it is really staggering to get that much premium. And the reason for that is the implied volatility rank is near its 1-year high at 97%. So we still go into this trade cautiously because of the old Wall Street maxim of there's no gifts on Wall Street, but because of this unusually priced $90 put, that is what's making that's what grabbed our attention and what is making us recommend this is a very compelling high rewards to risk trade. That'll wrap it up for today. Happy trading, and tune in for our next issue.